Okay, it looks like we have some more people joining, so we will wait a few more minutes. It's 6 o'clock sharp, and we'll give people a little bit more time to jump on before we get started. Awesome. Okay, let's see here. We'll go ahead and get started. Hi, everyone. Thank you so much for jumping on our webinar today. This is a live webinar brought to you by 2020 grant from the Denver Urban Area Security Initiative through the Homeland Security funding. And we're presenting this along with the City of Lakewood, and Jesse Miller is the emergency manager for the Support Services Division, who's helping make this happen today. And I'm going to just turn it over to him here for a minute and give Jesse a chance to say hello.
Hi, Carrie. Thank you. Just want to start by saying thank you to Carrie and United Policyholders and the Urban Area Security Initiative to help fund this and get this going. This is a great topic. I look forward to it. A little background on me. I'm the emergency manager for the City of Lakewood. I've been doing it for the city for about 5 years. I've been in emergency management for about 12 years, working with the federal government, state and local, and university setting during that time. And the longer I work in this field, the more important stuff like this becomes. The longest time, the focus has always been on building kits and creating your family emergency plan. And I know in my past 10 to 15 years, almost nothing is ever talked about in the insurance world. And I'm starting to see a lot more of it, and I'm starting to understand why. So I'm very much looking forward to this talk and the expertise that Carrie is going to be providing. So emergency management in the City of Lakewood is really just me. I'm the emergency manager in the police department in a civilian role. And I coordinate all the planning, training and exercise, response and recovery actions and mitigation as well for the city. This really is one of those big recovery being funded through the recovery committee in the region. One of the biggest steps that an individual can take is making sure that they understand their insurance and having the proper coverages and the proper levels. The city's going to very soon going to be embarking on an updated hazard mitigation plan that looks specifically at the natural hazards that the city is susceptible to. We're going to be working with Jefferson County here towards the end of the year to update that plan. It's done every about 5 years. And that'll really help cement as well a lot of the the hazards that we face here in Colorado. We get pretty complacent with not having a ton of huge events, especially in Lakewood, knock on wood. We don't have too many very large events, but the threat is absolutely there. And it doesn't even need to be a catastrophic event for actions like these to pay off. So, a hugely important topic. It's really the last thing that people think about. And I hope to change that narrative and get people, really focusing on this because it is such an important aspect. So thank you again, Carrie. I'll hand it back over to you, and I'll be here with available to answer any questions if they come up.
Thank you. Thank you. Okay, so we'll dig into it. And again, for those that have jumped on since I first said hello, my name is Carrie Wade. I'm the Colorado coordinator for United Policyholders. I became involved with United Policyholders when the Waldo Canyon fire blew into my neighborhood about 8 years ago and changed our lives in a big way. And we had to become very intimately involved with our homeowners insurance policies. I came from a background of medical insurance, and I knew it would be important. But I didn't realize how limited the resources would be outside of the insurance company in terms of helping us learn to advocate for ourselves. And this is where United Policyholders really has come in, and I've stayed involved all these years, and it's been a treasured relationship for me, and I'm very happy to be able to pay it forward. We are going to provide you with, we've sent you a link by email, and we're going to provide you with a PDF of the PowerPoint that I'm going through today, along with a number of other resources and a list of resource links that you'll be able to find connected with the talk today. So don't feel like you have to write a ton of notes. You can just follow along. It's a lot to digest. Basically, we just want to make you aware of these concepts and help guide you when you meet with your insurance company or you look at your risk portfolio of your belongings, your home, your rental, your car, to help guide you in how to make sure that you're adequately covered and you're getting the type of insurance you think you are for your money. And some like pearls and some tricks that we've learned along the way. So let's dig in here. I'd appreciate it if you would go ahead and hold on to your questions or type them in to the Zoom question and answer board. And if it is something we can answer live today toward the end of the presentation, we will. If not, we will send you an answer. So we will get to it. So just hold on to it while we move through this information because it's quite a bit. Okay, here we go. Again, about United Policyholders, we have been around for about 30 years, and we are advocating for and being information and a voice for consumers in all 50 states, both buying, what we're talking about now, preparatory knowledge for your insurance, helping people with claims following disasters, and then representing the consumer side of things legally. We're supported by donors, grants, and volunteers. We never take money from insurance companies or restoration contractors. We are a truly independent source and voice for consumers. And we are a trusted source for the media as well. This is a picture. Here I am, along with our executive director and a bunch of our volunteers with Governor Hickenlooper back in 2013. We were able to leverage all of the unfortunate fires and floods that we had over the course of a few years to get some legislative changes that were consumer friendly, and we're really proud of that. That's something we did here in Colorado. And we've done roadmap to recovery programs, helping people month by month over 12 months to learn how to navigate a large loss, like a fire loss or flooding, and the things that happen that can be really devastating to your life and your community in Colorado. We're currently doing the Roadmap to Preparedness program today. That's what we're doing right now, and then an Advocacy and Action program. Okay, so just to kind of give you a general idea of what we're talking about, insurance money, your insurance claim money, not charitable or government aid, is the #1 source of money and resources that help people rebuild and recover after a disaster. Popular word now is resiliency. In order for a community to be resilient to disaster, the individuals within that community need to have resources available to them that help them with a speedy and thorough recovery so that they can participate in the community again. And we know that as difficult as it can be sometimes to manage an insurance claim, it is the vehicle that we must all use to get whole again following a disaster. And so we really want to help you understand how to best work with what you have to get where you need to go. Government assistance is great. FEMA dollars come into play if there is a declared disaster. So they don't always come into play, but following a large disaster like the 2013 flood or the Waldo Canyon fire, they were declared disasters, and it may be possible to get as much as $35,000 for, you know, an individual or an individual family in a declared disaster in a grant, but they're needs-based and they only step in after you have worked with whatever insurance and resources you have. Small Business Association loans may be available following a disaster, but they take time to kick in, months really, and they must be repaid. And charitable aid is extremely important. We always partner with the Red Cross and many other organizations to help bring help to people following loss. But certainly those resources only cover basic things, needs and emergency provisions, not the cost of rebuilding. The main thing we want to teach people here is to be prepared and not scared. And the best thing you can do is become educated about what resources you do have and make good decisions about where your premium dollars go to protect you. So we are going to cover these things as we go down, so I'm not going to talk about them now. This is really important. We love to say this, the devil in dollars are in the details. And it's true. With insurance, everything is fine print and it's constantly changing. So you really have to keep a copy of your policy, your current policy year to year. You make an agreement and pay for a plan that you will keep for a year and it renews, but it may change. So when your insurance comes up for renewal, it's always a good idea to take a close look, get an updated copy, and make sure you know where it is. One of the concepts that I know we had trouble understanding right after the fire is that the cost to replace a home, the home you have now, the things you have now, is different than the cost of purchasing that same home as it stands. So the value of your home on Zillow or Realtor.com or any of those things, or if you got a real estate estimate of the value of your home, that is sort of the market value, which is very different than the cost would be to rebuild that home on the same piece of land if it were to burn down or to recover it from massive damage in a flood or something like that. And a very important thing to do is to understand the true cost of rebuilding your home and what the value would be. And we're going to help you with that. And in Colorado, especially along the Front Range, housing values, I'm sure everybody realizes, have really gone up just dramatically in the last few years. And it seems to be continuing even in the time of COVID. So we're seeing and hearing that the cost per square foot to build a home after a disaster is over $300 a square foot. And so thinking of that in real terms, if you had a 2,000 square foot home, that would be $600,000 as kind of a starting point, not including the land. So that same home may sell for quite a bit less than that standing today. And every single policy sold in Colorado, even within the same company, pick any major insurer, They offer many different policies with different terms. So language matters, and knowing what you have matters. We see two main types of problems when people have insurance claims. There are coverage problems, and those are very difficult to overcome after the fact. That's what you want to address now, when you can take a look at what it is you want to cover and what it is you're willing to pay to cover it and have it insured. Claim problems are another matter, and we will go over that a little bit too, but that's the main thing we cover in our Roadmap to Recovery program after a disaster. And it informs the first thing. So look at these people with masks on. Believe it or not, this was taken years ago. This would be the one place you would always see people with masks on other than an operating room. And this would be people, unfortunately, going through the remains of their home after fire, after one of the California fires. And there are a lot of different post-disaster problems, and we're going to work here to prepare you to understand how to mitigate that with your insurance. So we, after we do the Roadmap to Recovery programs, we do surveys of the people that participate. And in the 2013 Black Forest Fire here in Southern Colorado, the people, the policyholders who had damage or lost their homes were surveyed, and 46% reported that they were underinsured. That means that they did not feel they had enough insurance dollars in their policy to rebuild and recover what they had to their pre-loss level. We find this over and over and over again. That people are underinsured. So that's why we really push this point. And you'll see here that after the Black Forest Fire also, 1 year out, 57% had not even settled their claim, much less rebuilt. And I will get back to that again also. Okay, we're going to kind of dig into the meat of things now. And start with looking at the declarations page. So when you have a homeowner's or renter's insurance policy, you will receive, when you first sign up for it, or you'll be able to download, depending on the insurance company and if you go paperless or not, a copy of your policy. And that should include something called, like the first 3 to 5 pages will be declarations pages. And these are the things that you have selected that are very specific to you. And you want to look at those carefully and make sure they reflect your understanding of what your policy was supposed to be when you agreed to it. And then there will be a booklet, or the actual body of the basic policy. Every insurance company offers a variety of basic policy forms. And then your declarations page shows your exact coverage, which form you have, any additions or subtractions from that form. And that's what we're going to cover. So that's kind of the thing you want to always look at every year and make sure that it reflects what you think it should. And they all look a bit different depending on the company and the policy that you have. But they all will have some basic structure, and I'm going to show you 2 different ones. And again, you'll have copies of this if you want them to look at later. On this, we're looking at dwelling coverage A, which is the actual building itself and anything attached to the building. So like, you know, if you have an attached garage, that's part of your dwelling coverage A. If you have a deck, that's part of your dwelling coverage A that's attached to your home. The contents coverage C are often established at 75% of coverage A, and I'll show you that on the next slide. And then The contents are, if you were to pick that home up and dump everything out, whatever isn't attached to the house, that's your personal belongings, and those are contents in coverage C, and they're treated a little differently. And then other structures called coverage B are other man-made or improvements to your home or property that are not specifically attached to your home. So this could be fencing, could be retaining walls, it could be a standalone barn or garage or workshop, it could be a fire pit, it could be any number of things. And generally speaking, in most policies, they'll set the other structures at 10% of whatever your dwelling coverage is. And just know that that is often not enough for people, especially if they live in a somewhat rural area or a hillside with lots of retaining walls and specific types of improvements on the property. So that's an area you want to keep in mind. And then the fourth major area of your policy coverage, bucket of coverage we call it, is called additional living expense, ALE, or loss of use. And this can be either expressed as a dollar limit. It may be $200,000. It may be a time limit, 1 or 2 years without a dollar limit, or it may be some combination of both. And I will show you 2 examples of that. This is the pot of money that kicks in when your home becomes uninhabitable or unusable due to covered loss. So this only kicks in if it's a peril or a problem that is covered under that policy. And there is no ALE or loss of use in flood insurance policies, but there's almost always this bucket of coverage in both homeowners and renters, although much more is available under a homeowner's policy because it needs to be. Then, you know, on top of those basic buckets, there are endorsements and exclusions and riders and things like that that add and subtract from the policy and customize it for you. And it's important to understand those, and we'll go over those. And deductibles. Deductibles are really important. The deductible is the part of the loss that you will be responsible for before your insurance kicks in. And so generally speaking, if you are going to replace your contents, if you're going to fix or rebuild your dwelling, you are going to have to come up with that deductible out of your pocket in order to become whole again. Okay, I know I'm covering a lot, but just stick with me, and then we will be able to get to some of your questions as we get a little further down here. So this is the first example of the deductible page. And this is a standard homeowner's policy like you might have seen for years and years in Colorado. It's called an all perils. And what that means is all of the covered perils that the policy works for or covers have the same deductible. So whether it's wind or hail or a tree falls or lightning or fire, windstorm, tornado, those are all covered perils on most of these policies. They will in fact have the same deductible. And in this example, the deductible is kind of hidden, but it's right here. Excuse me, I'm going to go back to that slide again and just show you where the deductible is because it's kind of hidden. Here it is. It's a $1,000 deductible, and the form, the type of policy is an HO3. Excuse me. The other 4 buckets that we spoke of are the structure or dwelling coverage A. In this example, it's $300,000, 200. excuse me. The other structures, which is like the unattached garage, fire pit, that type of thing, retaining walls, again, in this policy is 10% of that 300,000, approximately. The personal property or contents here, and the loss of use. And in this example, the loss of use does not have a specific time limit listed on the deductible, on the declaration page, but there may still be a time limit, and there are some constrictions on that. It can't go on forever. On many policies, it's in the language. So not on the declaration page, but in the body of the policy, it will say you have 12 months or less, however much time it takes reasonably to recover from the loss. And after a certain period of time, the insurer may begin really pushing you to stop using this bucket of money and get back into your home. And then in this part of the policy here is where they're going to get into things like the, again, deductible being $1,000, whether there are any special endorsements like this building code upgrade limit here. And I'm going to talk more about that in just a few minutes too. Okay, let's go on to the next example. And so for this one, this is a different insurer, and these are actual copies of policies that are being offered right now. We eliminate the names to protect the innocent or not so innocent in this case. And in this particular policy, this is what they call a percentage special deductible for wind and hail. And, there are just some hidden costs potentially here that we want to make sure you understand. And as you can see, this is, looks very different from the previous example, but it basically contains the same information. You have your coverage A dwelling protection, your other structures, which is the unattached improvements. You have your contents or personal property protection. And in this policy, the loss of use protection is unlimited dollar amount, but it's up to 12 months. So it's different, but important to know. And a comment I want to make sure to make here is, given that more than half of people that respond to our surveys find that it takes longer than those 12 months to settle their basic claim, in many people, it can take 2 years plus to fully settle a large loss claim, and certainly to rebuild and replace your belongings. So it's extremely important to pay attention to this, because that loss of use protection, or the additional living expense, while your home is damaged and you're having to repair it and rebuild it and live somewhere else, it will pay the difference between what your mortgage was before and what your mortgage or rent was and is now. So if you were paying a $2,000 mortgage and still have to pay to the mortgage company while your home is being repaired but unlivable, and you're having to pay $3,000 in rental for somewhere to live while that's happening, that coverage D is going to pay that extra $3,000 a month for your like size and quality rental that you need to establish yourself in while you're recovering. It will also pay the difference between what maybe your food costs would have been in your own home and what they are while you're initially in a hotel because you have to eat out. They may pay, excuse me, for, all kinds of expenses that you would not have had you not had this loss. So it's extremely important to keep all of your receipts from any kind of loss in a notebook and track them so that you can recover this money, because this bucket of money only gets paid out if you spend it. So you have to show that you've spent it and document. And that's going to apply to a lot of things we cover here today. This is the liability section, and we're not going to get into that too much today because we have so much else to cover. So the difference between this policy, the percent deductible, and the policy we first showed you, which was $1,000 deductible for all perils, is that on this policy, you have two different deductibles, right? You have for all the other perils that same $1,000 deductible, but for wind and hail damage, which we have a lot in Colorado, and I think we've had like 3 storms in Colorado Springs already this year that produced a lot of claims. And I know back in, I think it was 2016, you guys in Lakewood had massive hail damage. So it's very relevant. This is a 1% of the dwelling coverage A deductible. So should you have a hail event, you would need to replace your roof. This would be your deductible, the $3,850 before the insurance money would kick in, versus the other perils being $1,000. The insurers are increasingly doing things like this to deal with the effects of changing climate and changing problems that are causing them to take on a lot of risk and losses. And so wind and hail are big here, so they're increasing the deductible. So make sure you pay attention to that. You know what your options are and what your coverage is and is not. The next section of the declaration page that I want to talk about is the better side, which is how you might be able to have credits and discounts from your premium. The insurers love to advertise about these discounts, and some of them are relevant and make a difference. So I'm going to talk about them a little bit. When you combine different types of coverage with the same insurance company, let's say you have, you know, one of the big insurers, State Farm, AAA, Allstate, anybody like that, if you get your home or your rental insurance and your auto insurance and perhaps maybe an umbrella liability policy or a boat policy or something, motorcycle, something like that, you combine them, they will give you discounts off of your premiums for doing multiple lines or multiple products with the same company. So make sure you ask about that. Certain memberships will give you discounts. And it's important to ask about that. There can be senior discounts, loyalty discounts. Just ask, are there any discounts that I might be able to avail myself to? Claims-free discounts, if you haven't had any recent claims. And then the age of your home and the age of your roof and the type of materials on your roof can also either lower or increase your premiums. And it's all about, with that, how much risk the insurer is taking versus how much risk you have taken or demonstrate. So know your deductibles, dollar versus percentage, know your loss of use, know whether you have replacement cost coverage or actual cash value. Some policies now are actually going to only actual cash value on roofs. And that means that if you have a $30,000 roof and they depreciate it because it's maybe 7 years old, then the value of that roof may be only $10,000. Well, when you have to replace it, it's still going to cost $30,000 to replace. If they're only insuring it for 10, you've got a big uncovered gap there to deal with, and you want to know about that. And there are some differences between homeowner and renters, and some major exclusions that apply to everyone. Generally, homeowners insurance policies do not cover flood at all, which is rising water. And Jesse asked us to make sure we touch on flood, and we're going to do that more later. They generally do not cover mold or pollutants either. Sometimes there is some limited coverage for these items if they're secondary to a covered peril. If you had a hurricane that knocked a tree into your house and rain fell into the house and caused damage, there's a chance you could have coverage for that water or mold that followed that water, but it's very limited these days. And then terrorism and earthquake are also exclusions in the standard homeowner policies in Colorado. Those are just some of them. So if you want that protection, you're going to have to purposefully add that back in. And you know, you're going to want to talk to your agent about those things and document your conversations with your agent about those things with email so that you can hold the insurance company accountable if you need to. There are some additional important things for homeowners to touch on. We talked about from the beginning, I've mentioned the dwelling coverage A, or the structure, you know, that main building and the things attached to it. And that's so important to make sure you're not underinsured. And the other buckets all follow that coverage by a percentage. So we'll keep hammering on that one. It's not really a good idea to have lower than necessary or realistic insurance there to save on your premium, because there can be just huge costs in that for you should you really need your insurance. Better to consider maybe some other ways to save money in your policy than with underinsuring. As a matter of fact, some insurance policies really penalize you if you intentionally underinsure. And because the people quoting you insurance, may be based on what the mortgage company says they require of you to have as coverage, or what the appraiser lists as the value of your home, it's easy to be wrong on this number of adequate dwelling coverage. This next item I touched on once before on the declaration page, actually the rest of them. These are, endorsements that you can add. Thank you. These are endorsements that you can add to make sure you have adequate coverage. So the extended coverage limits endorsement applies to A and B. So it applies to both that main structure and the extended or other structures. And when you get this, you can usually get up to 150% of that dwelling coverage A. Excuse me, for a small amount of extra premium. And what this does, I'm going to just give you an example, a story as an example. When 28 of my dear friends lost their homes after the Waldo fire, they found out that there are shortages of builders and building materials and supplies that force the supply-demand ratio to increase the cost of goods, sheetrock, cement, labor, all these things, as they become in shorter supply, kind of like toilet paper recently, these things become more expensive. So when you took your policy out, it may be that your adequate dwelling coverage A number might have been 300,000, but after the fire, it cost 500,000 to build that same house. Or let's say 400,000 to build that same house. The extended coverage limits endorsement is expressed in a percentage. So if it's 120%, it means you have an extra 20% over that 300,000. If it's 150%, you'd have an extra 50%, or that would equate to 450,000 to cover those increased extended costs. The second area that's very similar and can be a little confusing is there are also specific increased costs when you build a new home that have to do with the changes in the ordinances, laws, and covenants around what is required for safety and for aesthetics in building a home. So for example, if the home is 20 years old, it may have only required a certain type of electrical or roofing material. And now the city may have, or the regional building authority may have decided they want you to use a higher level of, have passed and want you to use a higher level of these things that are maybe more fire resistant, like a Trex deck versus a wooden deck or something like that. These building codes cause the cost of rebuilding that dwelling coverage A to go up more. And this is yet another bucket of money. So you could have maybe 300,000 here. Sorry, I'm not drawing very well with my highlighter. You might add another, amount of dollars here, and you might be able to add a number of dollars here that allow you, with the right coverage, to rebuild the home that you lost. And this is extremely important. So make sure you take this with you when you talk to your agent and you go over these things. Another important limit that we like to see people get an endorsement and increase is for sewer and water backup, because it's very common for there to be problems with flooding or the sewer system or septic tanks or mechanicals that will cause, that are not your fault, but that will cause sewer or water to back up into the home. And that's separate from a flood. That's a different type of peril. And you can get reasonable coverage for this for not a terrible amount of money. And the biggest problem is usually when they offer this endorsement, it may just be $1,000 or $5,000, and you probably want to kick that up, because if you have a finished basement and you have a sewage backup, it's going to cost more than $5,000 to repair that. So, and get it back to new. And of course, your deductibles will still apply as well. Okay, so we kind of went over this already, but I'm going to, again, just remind you about this. There are many ways that you can get this value right and add to it with endorsements to make sure you're properly covered. Some of the things that can help you is you could get a local contractor or builder to give you an estimate of what it would cost to build that same home new today. And that can inform you well. Sometimes you can ask your insurance company themselves, hey, I would like you to participate in determining the value to replace my home. Will you send an appraiser? My insurance company actually did that for me this year. And it did raise the cost of my home to rebuild from what I thought it was. And therefore I increased my dwelling value coverage A, and feel better about that. And the difference in cost is very small, usually incrementally, when you increase that number for some reason. You can also use some software. There are many different types of software. All of these things can inform you. They're not absolutely perfect methods, but they can inform you. What is not a good method, again, is the real estate or market value, because those are just not adequate. And the value of your coverage A never includes the land value. So they do not factor that in. So when you're looking at that number, just know your land is not insured. You may have some landscaping insurance in your policy. You may have some improvements insurance, but the actual value of the land remains because the land remains generally. This is just a slide to give you more detail on the exclusions that are not included. I've already gone over it, so I'm going to skip right through it. But these are the things for standard homeowners policies, and there are more, that are generally not covered. Earthquakes, terrorism, damage caused intentionally by someone living in the home, wear and tear are not covered by homeowners insurance. And then endorsements are those add-ons that you do. Generally, there are like over 100 possible different endorsements for standard homeowners policy. So you really just need to talk through it with your agent. But these are the main ones that I have just covered that you want to consider adding in to make sure they're there and they're adequate. Now we're going to get into personal property a little bit. So let's take a breath and shake it off a little, because we're entering into a whole nother category of things. And I'm going to take a quick question from Amy, who says, it was stated that the land value remains because land remains usually. What about when a flood washes the land away, for instance, when a river changes course? Thank you for that question, Amy. Homeowners insurance specifically does not cover flood, and it just doesn't cover land. Things like landslides, floods, mudslides are not covered under standard homeowners policies. So they just aren't, and that's the way it is. And we'll talk a little more about those other types of policies before we're done here today. Thank you for that question. Okay, coverage C is for contents. It's personal property. It's anything that isn't attached to the home. So it could be appliances that are not built in. Built-in appliances that are physically attached are generally considered a part of the structure. But other things are not, like if you have any collectibles, weapons, jewelry, monetary things like coins, money, securities, clothing, anything that you can think of. Business equipment is capped. Silverware, you know, Grandma Rose's china, things like that, all of your belongings. And believe it or not, the average family has over $30,000 in replacement cost in items that are under $3. That is something the insurance industry has put out and that we have found. After people lose their home, they go to the department store for the first time or the grocery store to replace basics like socks and pajamas for their family and toothbrushes and things like that. It adds up very quickly. So do not underestimate the value of your contents. Much better to be a bit overinsured there than to be underinsured there. And beware that your insurance policy covers your contents to replacement value, because otherwise it's just depreciated so quickly and you will not get enough resources back to buy new again. Most policies in Colorado now cover contents for replacement value, but please do double check. That is not a place you want to skimp. And beware of sublimits or special deductibles for things like theft. And many insurers will say they want you to schedule your valuables. So if you have a wedding ring, jewelry, a special collection of musical instruments, your business equipment, coin collection, these things have limits unless they're scheduled. And I just kind of want to show you that. Here are some typical limits. The policy will only pay up to this amount after your deductible on these types of goods that are personal property items. Usually, if you look at it, you can see why, because they're things that may be easy to steal or hard to replace. And sometimes there are special, like for theft, there may be a limit that is lower. So you could only recover $1,000 after deductible on stolen jewelry, whereas if it was a fire, you may be able to recover the full amount up to your policy limit. Let's see. Again, and this applies to every category I'm talking about, make sure that you become sort of obsessive about documenting your belongings. Even if you do it just for an afternoon and store it in a safe place, like email it to yourself in the cloud, zip it and put it on a drive and a little flash drive and tuck it away, or give it to your sister, or send pictures to family and use a spreadsheet. You can even hire professionals to help you document your belongings. It's much easier to have those lists ahead of time than to try to recreate them after a loss. Some of the most painful moments I have had are sitting with friends and survivors trying to document all of their belongings in order to get their insurance recovery. Unfortunately, most insurance policies and adjusters do not pay you for your losses until you document them. And so, one pair of socks at a time, and one pot and pan at a time, and one pair of pants at a time can be very painful. So if you walk through your property, opening drawers and closets while you video or take pictures, and if you can video on a smartphone or tablet and narrate, and look at the details of the interior and exterior of your home. If you have special wooden floors, make sure you include that. Anything, any kind of art or serial numbers that you can document ahead of time will save you so much pain if you have a loss event. Okay, so enough of that. If you do want a second opinion on the value of your home, or on getting multiple quotes, this is a benefit corp that UP is partnering with to help you connect with an independent insurance broker or two who can give you quotes on policies, and you can try to make sure they're apples to apple quotes. We recommend people get 3 quotes from 3 reliable, well-rated companies. And when it comes time for you to renew your coverage, each year is a good time to go through things, and then again, touch base with your adjuster. Some of the things you might want to make them aware of is if you've done any updates or remodels, if you've finished your basement, added a new deck, done improved materials. Make sure that you get your permits finalized with the building department if they're required, because that will be important in updating the value of your home. If you have someone move into your home and you want to make sure you cover their belongings, you want to let your agent know that. If you work from home now, as most people find that their work situation has changed in one way or another. You may be commuting a lot less, you may not be working at all, or you may be working from home. You may be participating in the shared economy now, selling things on eBay, maybe being a provider for care.com. All of these things affect your insurance needs and your premium prices and your coverage. So let your insurance company know about these changes. If you have a change in your marital status, that's important to let them know about. And this is kind of an odd one, but if you do get a dog, be sure that the breed is covered under the policy, because especially in some places in Colorado, certain breeds are not covered, are considered illegal to own and would not be covered by the policy. So I really encourage you to pay attention to those things when you are going over your policy. And ask what if questions. That's how your agent earns their keep. They get a commission, if you will, when they sign people up generally. And they are not claims adjusters. So how they earn their keep is by helping you understand and assess the needs for your policy. Let me do a quick time check here. Okay, we're getting close. Jesse also asked us to touch on something called loss assessment coverage, and this is a special consideration in policies. And the Division of Insurance has also let us know that these are getting to be problems for consumers in Colorado. There are lots of neighborhoods, both individual homes or townhouses, apartments, condos, where there are homeowners or townhouse associations or condo associations. In those communities, you pay a monthly fee in the way of a homeowner's cost each month. And as a part of that, that homeowners association has generally supposed to have an insurance policy to cover common spaces. So this would be things like signage for the neighborhood, maybe fencing, maybe some landscaping that's shared. And it could also be in townhome associations and condo and apartments. It could be things like shared walls, the exterior, we call it sticks out from the framing of your townhome out and up. And that would be a common roof, shared walls, maybe even the decking outside could be covered under the homeowner's insurance. You would have your own policy that would cover the sticks in and your contents and your liability. And this homeowners association type policy also has deductibles, exclusions, and limits, just as all policies do. So if there's damage that's not covered because of a deductible, or maybe it's just not a covered item under a flood or something like that, the way these joint ventures, the homeowners associations, deal with it is they can issue, as a part of your covenants in that association, your legal covenants, a special assessment to every townhome owner or condo owner or homeowner. So collectively, they can collect enough money under that special assessment to pay for those roofs or whatever is damaged. A friend of mine who has a townhome here in Colorado Springs had a loss assessment recently for hail for roofing that was $23,000. So it's not a small thing. And it's important to understand your exposure there in your safety net. And generally speaking, homeowners insurance policies don't have a lot of loss assessment coverage automatically. They may offer it as an endorsement, or they may offer a small amount and you can increase it with an endorsement. So what we're hearing is it is wise to look at this and consider increasing it. Just be aware that there are exclusions in this too. Again, everything is fine print, but we just want to make sure you know what the problems and potential solutions are. We are including a slide here for you that you can print off and use to ask your agent to get informed on this subject. And we're getting short on time, so I'm kind of going to blow through some of this. And you can ask more questions or contact us online with further questions if you need to, because I want to let people get back to their evening and ask a few questions here. So this is one example, which is wind and hail deductible, like I talked about earlier. And what I want to demonstrate here to you is if you choose an all perils fixed deductible of $1,000 and you have a wind event or a hail event or fire event that damages your roof for $30,000 worth of damage, to bring it back to its pre-loss condition, you would generally in that policy be responsible for the first $1,000, and your policy, if it's a covered loss, may pay up to the other $29,000. On the extreme end here, if you have a 2% deductible for that wind hail damage, and it's $30,000 worth of damage and it's a hail damage, you will have to pay that first 2% of the value of the home. The value of the dwelling coverage A is $400,000. That's $8,000 out of your pocket in order for the roof to be replaced, and hopefully insurance would cover the other $22,000. So please remember to look at this and talk about it with your agent when you're getting quotes, because this is very important. This is another slide with another example, which adds even more risk to the homeowner. If you have cosmetic only exclusion, which sometimes they will put, and it would be right there on your declarations page, you could end up literally getting no money from your insurance company and having to pay that $30,000 all yourself out of pocket, even though you have a homeowner's policy. So, you know, take a peek at this and talk to your agent about it. Now we're going to do a quickie on flood insurance. This is like super quick flood insurance, FYI. You do not need to be in a flood zone to need and want and benefit from flood insurance. Between 2014 and 2018, the National Flood Insurance Program, which is the government subsidized flood insurance that most people have if they have flood insurance, says 40% of the flood claims were outside of high risk areas. You can type your address into the FEMA Flood Map Service Center flood zone map to see what, and you see this, I don't know if it's popping up on your screen, but the actual link we will, you can get to through this floodsmart.gov down here, or we again have sent you guys a link to resource links, and we have that all there. So you can check that out. It's super easy to do, and it will tell you what kind of risk you're in, and you can also acquire a quote for flood insurance. Your agent for one of the big homeowners companies may or may not offer you national flood insurance as an option. They can sell it also, most of them. If they don't sell it, you can always access it online, and it is still a program that is currently subsidized. Your mortgage company may require you to have flood insurance if you live in a high-risk zone. And so you will want to know those things and be informed about that. There's also a 30-day waiting period. So let's say there's a fire in the community, and we know after the fire, the forest is denuded of trees, and flooding is much more likely in the community if there's a big rainstorm like happened after my fire in Waldo Canyon. Usually there's a 30-day waiting period from when you sign on before your policy is in effect. Sometimes they will waive that in a disaster and make it effective immediately. Be aware that the residential limit, the most insurance you can buy for your dwelling for flood from the NFIP is $250,000 for a resident. It's a whole lot better than nothing when you need it. Contents would be covered under completely separate policy and is limited to $100,000, and it excludes anything below grade. So if you have a finished basement, that will not be covered under the flood insurance policy or your homeowner's policy for flood. The way they define flood with the National Flood Insurance Program is an excess of water on land that is normally otherwise dry, affecting 2 or more acres or 2 or more properties. So the flood can't just be restricted to your 7,000-foot lot. It would have to affect 2 or more properties and or 2 or more acres. And this is all sort of restricted to rising water. In other words, water that rises up is considered flood, whereas falling water, which may cause rising water, but falling water in and of itself is not flood. So it's very particular. And flood insurance does not include any additional living expense coverage. It just doesn't. Flood insurance is mostly just available through this government program. Most insurers dropped it. There are a few, Lloyd's of London, and there are a few other carriers who offer flood insurance, but mostly it's only available through this government program, and it is currently subsidized and more cost effective than it would otherwise be. I'm going to let you guys read up on the Clue report. This is basically a sort of a credit report for your insurance risk profile that all the insurers keep, and they use it to decide how much to charge you for premiums based on how they see your risk. Even things like your marital status, your credit rating, and how many claims you've had in the past, your age, the city you live in, the zip code, all of those things can come into play. You can get a copy of this for free every year, just like with your credit report, right here. And make sure it's accurate and ask them to clean it up if it isn't, because it could be causing you to have higher premiums than you ought to have. I had 2 mistakes on mine, which I was able to clean up. There are ways to save on your auto insurance here. And one of the things is there are COVID considerations. If you are not driving very much, if you're not going to work every day or working from home, this can cause your auto insurance to give you a discount. Don't be afraid to ask. Ask, it can save you money. The Division of Insurance is a division or department of the regulatory agencies of Colorado. And they are there to help you learn about the insurance providers and how you can advocate for yourself and choose wisely. There are regulations that are listed there, and some cool tools like the premium comparison tool that helps you link to different insurers in the state to get quotes. They have an excellent buyer's guide to homeowners insurance, and you can ask questions or make a complaint online. Never hesitate to ask questions or make a complaint. Your insurer cannot penalize you for complaining, and it gets their attention. Sometimes that's what it takes to get them to pay attention if you're not getting the service that you need. They have a COVID bulletin. These are all links that we're going to provide to you as well to help you. I've already talked about that. Be thoughtful about filing small claims because it really can increase the cost of your insurance. However, you really don't want to avoid filing a claim if it's going to push you past your deadlines and you might have hidden damages or increased costs later on that would cause you to want to have that insurance available. If someone was injured, you must report it to your insurer, and you must do your best to secure your property after damage. So if you have a broken window from hail, a skylight or something, and your home is exposed to the weather, you're required to take action right away to protect it from further damage in order to protect your coverage. So make sure you're aware of those duties and responsibilities under the policy before you decide whether to file or not to file. Got some good information for you here, and please be aware that should you be dropped by your insurer, which happens sometimes following like a bad wildfire season, it may be that certain insurers start looking at dropping coverage, or if you've had several claims or some other problems that cause them to decide they don't like the location of your home relative to the fire department, or they change their own internal rules. There are regulations about this. They have to give you a certain amount of notice. They have to give you a reason in writing. Don't panic. Just start shopping. We have a guide. We will have a Colorado specific guide for you in short. And again, the Division of Insurance here has great help about this. So don't give up. Know to ask independent agents. Don't just call the top 3, because sometimes they're more competitive and just as good. Okay. Whew, we made it through. I'm sorry it went a little bit over here. I'm about 10 minutes over. I apologize. Let's see if anybody has any questions. Nope. Thank you so much, everyone, for hanging with us. We really appreciate it. It is kind of dry material, just like my throat is now, but it's so important. This is how you recover. You spend your life paying insurance premiums, and when you need it, you want it to do what you need. So thank you so much. Sorry, I'm going to give you a moment to ask a question, additional question if you'd like. Otherwise, it's probably time to get on to dinner. Thank you, everyone, again so much. This will be available in the future live, not live, excuse me, recorded. You'll be able to link to it. And remember to look for that PDF. Thank you, Amy, Katie, Linda, everybody that stuck with me, and have a great night. Thank you so much.